Hello everyone. This is going to be a quick video on how I utilize OHLC, or open, high, low, close. So OHLC is a super simple concept. This is how these candles on your charts form. So for a bearish candle, we have the opening price, then we have the high, then we have the close, and we have the low. For a bullish candle, we have the opening price, the closing price, and the high and the low, regardless of what time frame this is on. Okay, so super simple stuff, but this is how these candlesticks are booked, right? So how can we use this to our advantage for the main framework of our trading? So further in depth of just the open, high, low, and the close, if our bias is bearish, regardless of what time frame this is, at the start of that time frame, we should expect some form of manipulation before the distribution phase. So say this was a 4-hour candle at 10 a.m., which we have an example on in the following slide. We should expect some measure of manipulation that serves as the Judas or the false move or the manipulation phase before the real distribution down towards our sell side objectives. Conversely, when we are bullish, we should expect some form of manipulation to the downside before the distribution to the upside. So using the same example, say this was a 4-hour 10 a.m. candle, we should expect some false move lower to trap shorts before distributing higher to buy side objectives. So an example of this is a 5-minute chart, okay? But bias was bearish in this situation. And as you can see, this is the 10 a.m. candle. So ICT teaches what? The AM session time-based silver bullet model takes place between 10 a.m. and 11 a.m. That's when you want to be looking for entries. Now, in this specific situation, price was at low of day down here at 10 a.m. So we expect some form of manipulation to serve as the high of the candle to trap longs and to dig back into a premium. So we don't want to short. Now we have this, if you're following my cursor, we have this little SIBI here, this little fair value gap. You don't want to short this because, one, we're already in a discount and you don't want to short in a discount, but we expect price to get back up to a short-term premium, serve as the high of the wick for the 4-hour candle before distributing lower to sell side objectives. Okay? Now, this graphic, it can look a little confusing right now, but I will walk you through it using that same logic. Okay? So our sell side objective is here. By extension, our bias is bearish. This can be the opening range anytime before 10 a.m., the price leg before 10 a.m. that we're delivering from, right? So if this is the 10 a.m. candle, just like in the previous slide, we want to see some measure of retracement back to a premium before reaching that sell side objective. So if we're around low of day at 10 a.m., we don't want to short this. We want to wait for a better setup that does what? Come back to a premium. Now, in this graphic, this green line is serving as the high of the price leg, and this red line is serving as the low of the price leg. So about midpoint in here is equilibrium. So anything above that is what? A premium. Now, this is the model that I typically look for. As long as this sell side objective is not complete, all I'm doing is waiting for us to come back to a premium into what? A higher time frame PD array. Now, this can be anything, preferably, of course, you want the higher the time frame, the better, but this could even be a 5-minute fair value gap, inversion, order block, 15-minute, PD array, hourly, 4-hour, daily. It's just a specific level that you're watching to see if there's any respect and if price is refusing to go above it, okay? On top of that, I want to see a short-term swing high broken here, okay? So you're trapping breakout traders that are getting long above this high, but you're just coming back to a premium to allow smart money to accumulate their short positions before going lower. Now, entry is preference, but I typically like to use an inversion. You can use the classic 2022 model, just a SIBI here since we're bearish. I like to use inversions because it is the final confirmation that we should go lower and continue reaching for sell side. Why is that the final confirmation? Because we're back up into a premium and we've swept the buy side and we've left the sell side objective. Now, all I want to see is this. So it would be a BISI, right? It would be a fair value gap. All I want to see is price disrespect that, close below, and I execute on the 1-minute time frame. I'd want to see it close below that BISI, by extension making it an inversion fair value gap, and I would enter on the retracement and target the sell side objective. Your stop loss, your risk is all preference, but I would typically put it above this swing high, or you could do a close above the inversion, because once we close back below this inversion, if our bias, which is bearish in this example, is correct, there's no need for us to go back above the inversion. We can wick above it, but best case scenario, you don't want to see any bodies close above, because what does ICT always say? The wicks do the damage, the bodies tell the story, okay? So screenshot this, look for it in your charts. Don't just take my word for it, but this is one of my favorite models because this last confirmation of this failing is showing me that price is disrespecting discount or bullish PD arrays. Okay, so if we were bullish, this fair value gap should have supported price, but all we were doing was coming back to a premium before going lower. So I require this to fail before entering a short position, targeting our sell side objective. An example of this is right here on this 1-minute chart. So this black line, I do not have it annotated, I apologize. This black line is a new week opening gap low, and the red line above, the dash red line, is the new week opening gap CE. Okay, so price retraces up at 10 a.m. back to a premium. Is it retracing back to some random level? No, it's retracing into the new week opening gap on a short-term premium of the intraday range to allow smart money to accumulate shorts before going lower. Now you can also see we left these equal lows. So this is engineered sell-side liquidity. Okay, so if our higher time frame bias is already bearish and we see these equal lows left on the 1-minute or lower time frames, right? All we're waiting for is the setup that I described in the previous slide. So price comes back up, right, into the new week opening gap, sweeps this high, and we can go into this on a deeper level in a future video, but an algorithmic signature that I love is when price fails to get to the CE or the midpoint of an inefficiency, okay? It's just the algorithm showing us, tipping its hand that price is weak. It doesn't want to even reach for the CE, the midpoint of the new week opening gap. It's just coming back to a premium, and then once we displace away, we're looking for the model, we're looking for shorts to go to these equal lows, and if you want to hold for longer, again, it's just preference, further sell side objectives beyond these equal lows. Okay, so that same logic, 10 a.m., the opens down here. We don't want to short down here. We want to wait because we expect some sort of high to be formed on the 4-hour candle to serve as the manipulation phase before the distribution phase lower. Okay, so as you can see here, we come back to the new week opening gap one more time. We have this large BISI. It fails. Do any bodies close above it? No. That's what you want to see. You can put your stop above this high. You could have done a stop with a close a candle close, above this inversion again, and it delivers to our target beautifully. So these are the type of setups that I love, right? Into a higher time frame PD array, displacement away. The cherry on top is the failure to get to the new week opening gap CE. But like I stated, we can discuss that in a further video. And then this failure of this BISI is the last thing I require to show me that it's going to go lower, because it did not respect this. Okay. This is another example. So the price leg that we are in is this high circled right here with a yellow circle to this low with this yellow circle. So from this low to that high, equilibrium is right here, this black line, 14,363. This is an example on NASDAQ. Now, London low is this red line. It's not depicted in this chart, just for organizational purposes. But you can see how price came all the way down and didn't take it. When this happens, when we come close to a session low, session high, and we can talk again in a further video about session lows and session highs. When this happens, you really want to be monitoring if we're going up to a premium, if price is rejecting price out of a higher time frame array. So even in this case, we have what? This brown box is a 5-minute inversion fair value gap. Above, as you can see, this black line is equilibrium of this price leg. We're coming into the 5-minute inversion above equilibrium, so in a premium, and we left the the London low, the sell side objective, it was not taken. So if London low was taken, this would be a different scenario, but since it was not taken, we have even more sell side liquidity right here. So once we get up here, I'm just monitoring, do we respect that 5-minute inversion? As you can see, even on the 1 minute, we do. We're wicking above, but the bodies are not closing above, okay? So once this fair value gap fails, this BISI, it's confirmation that price is not respecting discount or bullish PD arrays to support price. It doesn't care, right? And then we come back up, I enter there, my stop's above this high, and I target London low, okay? And that is going to be all for this video. I hope you guys learned something, but open high, low close, just understanding that as a main framework for timing, for when you want to enter. So the examples that we discussed, if a 4-hour candle that opens at 10 a.m. and closes at 2 p.m. If we're at low of day and we're bearish at 10 a.m., why would you short there? You should expect the high of that 4-hour candle to serve as the manipulation phase and reach up to a premium before reaching lower for sell side objectives. So something to keep in mind with your trading, open high, low close. I know it's super simple and there's a ton of ICT and other trading concepts out there and it's easy to get lost, but having this as the framework or the basis of your trades or your thinking, your analysis, right? It'll help you out a lot in understanding when it makes sense in regards to time and discount premium, when it makes sense to enter a trade, or when you should wait for a pullback or a retracement, okay? So I hope you guys learned something. In the description below, there will be my free Discord link. Come join that. Follow me on Twitter. I post content on there as well, but Discord is free and I live trading there most days, and we're all just in there trying to learn. So thanks for watching, guys. Let me know what you think. I will talk to you guys soon.